Hi everyone, welcome to our DAT IQ show. This is our update for September 17, episode 308. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy and special guest Erica Wilson. Hi everyone.
Hello.
Yeah, great to have you on, Erica. We've read a bunch of your stuff in some of the trade magazines, so that got me thinking about getting you on the show here to talk about rising insurance costs, IFTA, some of the tricks of the trade when it comes to setting up new carriers. So for those new to the show, tell us a little bit about your company and what you do.
So I own Wilson Transportation Services. I'm located in Easton, Maryland. I guess you could say I've been in trucking my entire life. My dad was a Peterbilt, an international salesman here locally. My uncle owned a Peterbilt dealership in Easton and Manassas, Virginia, and Landover, Maryland. So he had several locations. So my dad was a salesman for 45 years. So it's kind of in my blood. I started working for a spin-off insurance agency from the dealership back in 1993, right after I graduated high school. It was owned by my cousin, and I just started my way up there. And now I own my own transportation consulting business. So pretty much known around here for helping guys start up and keeping them in business. And then I do everything. You know, I start from the beginning with their LLC, get their DOT, and then I do their insurance. And then I help them stay in compliance throughout the year.
Yeah, good for you.
Every year.
I can't wait to talk a little bit more about that at the back of the show. How about you, Chad? How's things in Florida?
Yep, things are well. Looks like we'll stay out of the 90s this week, so that's a nice break. We'll call it fall in the upper 80s.
Yeah.
But yeah, I'm looking forward to hearing more about what Wilson Transportation does.
Yeah. All right. Well, let's dive into our market update so we can bring Erica back in as quick as we can. Some of the key trends we're watching this week. Spot rates were, sort of flat to down in dry van and reefer. Not a lot of change. Flatbed really was probably the biggest mover this week. It erased all of the gains from the prior week as we continue to follow pretty much seasonal trends ahead of some of the market seasonal movement we see around Halloween and Thanksgiving. Hurricane Francine didn't really make a big impact on the national market. It hit the landfall region around Louisiana as a Cat 2. The state's largest oil refinery and the sixth largest in the US reported minimal damage. It was back on production pretty quick within about 36 hours. It dropped to about 20% production during the storm. So there could be some impact on diesel prices this week when the EIA announced their national average. Of course, the big news we're all watching is the International Longshoremen Association labor agreement is set to expire on September 30. If not ratified, that could create another supply chain crisis as shippers are looking to get inventory into warehouses ahead of Halloween, Thanksgiving, of course, retail season up to Christmas. And then, of course, we've got the federal election in the middle of all of that. So this is a precarious time for those in the supply chain. There's already rumblings about solidarity between the longshoremen on the West Coast getting involved in this. So there's something we've got to watch in the next couple of weeks. On that subject, imports were down about 2% in August. They're still up 15% year over year, but peak import season looks to have passed following the record high volume that we saw in July. Of course, it's National Truck Driver Awareness Week. That started yesterday. Every September, the industry celebrates and honors our nation's truck drivers. This year, it runs from this week from 15 to 21, so it'll end on the 21st. A lot of trucking companies do various things during the course of the week for their drivers. Our partner in the St. Christopher's Truckers Relief Fund has a big project going on. You can find more about it on their website. They're donating to this year's Truck Driver Appreciation Week. Bunch of sponsors involved in that. And in this week's market update, you can find it at dat.com/market update. That'll be out this evening. We're talking about the end of the road railer, where weekly volumes on the rails have dropped 78% since the Great Recession. These are the road trailers that go on the back of railroad flat cars. In the end, the economics of putting trailers on flat cars just didn't stack up. We're also looking at some of the new temp-controlled warehousing in Maine. That's going to impact Northeast dray carriers and reefer carriers that run out of Maine, especially the seafood that comes in from Iceland. And the Home Depot sent a pretty dire warning to the market based on their last earnings call. That will have an impact on flatbed carriers as we go through the rest of the year. All right, let's quickly look through some of our market indicators. Load to truck ratio and dry van volumes bounced back last week. Again, no surprise there. We had a big drop after Labor Day, and then they bounced back with the first full shipping week after the Labor Day break. Carriers returned to the market in much higher numbers. They were slow to come back during the Labor Day week. Load to truck ratio down slightly to about 3.27. That's sitting about 8% above the long-term average for this time of the year for week 37. In the refrigerated market, again, same trend. Carrier equipment quotes were back up. Load to truck ratio down about 8% to 5.03 loads per truck. That's sitting about 20% lower than the long-term average, so a much softer market in refrigerated. And in flatbed, load posts actually went against trend last week. They were up slightly. Carriers did return to the market also, along with their counterparts in dry van and reefer. Load to truck ratio is up slightly to 11.80 loads per truck as a result of more carriers coming back. Having a look at our year-over-year look at spot rates, dry van line haul rates dropped below the 3-month trailing average by about 3 cents a mile last week. They were down a penny per mile to $1.61. They're about 2 cents a mile higher than last year and about 3 cents a mile higher than 2019, as you can see on the chart there with the lighter green 2019 chart in the chart line in the background. On our top 50 lanes, based on the volume of loads moved, rates decreased about 3 cents a mile on the top 50 to $1.96. Remember, these are line haul rates excluding fuel. So the top 50 lanes average $1.96. That's about 35 cents a mile higher than the national average of $1.61. In the refrigerated market, rates were flat last week, sitting just under $2 a mile, a little bit over $1.99, much of the same as we've seen since the July 4 peak. They've been about this level for about 10 weeks now. The national average for last week is about 2 cents a mile higher than last year and sitting about 4 cents a mile higher than the long-term week 37 average. At $1.99, reefer spot rates are the same as the trailing average for the last 13 weeks. So again, fairly flat there. And lastly, in flatbed, line haul rates erased the prior week's gains last week. They were up about 3.5 cents during the Labor Day week. They were down 4 cents a mile last week to $1.97. Line haul rates are about 2 cents a mile higher than last year, sitting about 11 cents a mile higher than in 2019, our last seriously soft market before this cycle, and sitting about 4 cents per mile lower than the 3-month trailing average. All right, let's have a quick look at our forecast for this week. Remember, we've got a new forecast methodology, as you can see on the charts. This is the short-term forecast using our flagship RateCast. That's in green. It's predicting what rate view will be 35 days out. It more heavily weights longer-term seasonal trends. The forecast is bounded by the upper and lower forward-looking error bands, exactly as it's displayed in all of our products. The blue line is a rolling 7-day weighted average of historical rates. These are for loads moved over 550 miles, excluding fuel. So these are truly line haul only long haul rates. So let's have a look at the dry van market. As you can see here, RateCast has got rates going out towards the early part of October, about the start of the third week, about 10-19. Rates typically decrease in that period leading up to Halloween. Halloween will be at the midpoint there at the end of October. So you can see rates sort of moving up a little bit there around the end of the month, and then they taper off. So RateCast is forecasting rates to be down 3 cents a mile out to the 19th of October. The lowercase forecast in red, a little bit more pessimistic, has rates down 10 cents a mile. I think RateCast is going to be pretty much accurate where we see rates end this time next month. The high case scenario has got rates up about 5 cents a mile. I'm not sure that's going to be the reality that we face here. There's still a lot of excess capacity demand. It's still fairly soft in the market. Things are still moving sideways. So that's where rates are sitting on dry van. Refrigerated, a little bit similar shape to the chart. Again, RateCast is seeing rates down 4 cents a mile out to October, a little bit of a bump around the end of the month. The high case scenario has got rates up 3 cents a mile. The low case scenario, fairly pessimistic, down 11 cents a mile before we get into the Thanksgiving shipping period leading into that holiday event. And lastly, in flatbed, little bit more optimism here. Ratecast is looking for rates to be up about a penny per mile over the course of the next month, but up a few cents per mile by the end of the month. All the three models are seeing the rates taper off, though, as we get into October. So that's it for our short-term forecast. Chad, what are you seeing on the contract side of the market?
Yep. So everything Dean just reported was from a broker to a carrier perspective. This section here will focus on a shipper to carrier or broker perspective. So this first graph here is dry van mix of contract and spot rates there in blue and yellow. And the black line is the difference between those rates. So this goes all the way back to 2016. So you can see the market cycles there. And you can see that currently that spot premium ratio, or SPR, that black trend line is sitting at negative 10%. So it's been trending down the last several weeks. So continued softening in this market, prolonged as long as we've ever seen it. And that mix of spot shipments is around 24%. Slight increase there last couple of weeks. Could be some shippers utilizing more spot where they might normally use contract. Let's go forward to refrigerated rates or temp control rates. Same type of trend there, a little bit of spike in that spot premium ratio. We might see that settle down as more data comes in for that particular week. And then moving on to flatbed, we see spot premium ratio still at negative 9%. So those spot rates still offering discounts in all three modes. No clear signals yet of that going over that 0% threshold that we're waiting for to see a turn in the market. That's a wrap on the contract rates.
All right, thank you. All right, so let's bring Erica back in. Erica, let's start off with I guess a fairly broad-ranging question, but what's the one thing new carriers always overlook when they start out in the trucking business?
So I think the main thing that they overlook is a lot of the back office stuff that has to be done. They're so eager to get in it and start hauling right away, and once their authority's active, they're ready to go. But there's all of this extra stuff that has to be done that's not really in their face all the time, but it's back there lingering, and it needs to be taken care of because it's going to be an issue when they go through their DOT audit. And as they stay in business, as they go through roadside inspections and they get violations, and it's important that they understand how all of those DOT regulations have a huge impact on their business, not initially when they start up, not only initially when they start up, but as they go forward from 5 years from now, 10 years from now, it has a huge impact.
Right. Do you provide a lot of the administrative services for them in terms of keeping the paperwork, or do you sort of give them templates and a guideline on what they've got to keep in their own office?
Both. It depends on the carrier. There's a lot of the owner operators just would rather me, take care of all of it, but it's really an educational, the communication between me and the owner operator is huge. They've got to understand what everything that I'm doing for them and, and what it means. And because I tell them, I may not wake up tomorrow, so you need to know all of this stuff, and you need to make sure you understand. And if they're ever held to the fire, they're the ones that they're going to have to feel the effect of it, not me. So it's important that they know everything that I'm doing for them. They understand it. I'll help them with the driver qualification file if needed. But there's other things that they have to handle, and they have to understand why it's required and how often they need to, maintain it so that they're in compliance just at the minimum level, just enough so they can handle it in case DOT comes calling for them.
Erica, I would expect a new owner operator entering the industry, probably looking forward to spending time on the road and driving trucks. What percentage is that mix of admin services that they have to perform versus being out on the road? What is that mix like?
I would say it's probably 20% admin, 80%, dealing with, they have enough to deal with when they're out on the road and dealing with all of the traffic and, people and their inattentive driving and, dealing with shippers and brokers and getting loads and all of that stuff. So
right.
That's why I always tell them, once you get it out of the way, it's so easy to maintain going forward, because it's just little things that have to be done going forward to keep you, in compliance. But it's that very, very instant, overwhelming amount of paperwork that's thrown at them that kind of is intimidating. So it's we try and break it down piece by piece. Let's do one thing and get it done, and then we'll do the next and get it done, just so it's not overwhelming, because they really do. They want to hop in that truck and start hauling right away.
Right.
Erica, talk a bit about income fuel tax assessments and how they are paid quarterly, because on our side, we see carriers kind of get into a cash flow crunch at the end of each quarter.
Yeah.
And when we track DAT numbers of carriers that are changing their authority status, there is a definite trend around the end of each quarter where carriers revoke their authority. Do you think there's a relationship between some of the big payments they've got at the end of each quarter, such as fuel tax?
I don't think that has an impact on carriers shutting down. I think, that they're probably, them thinking about shutting down had probably started long before that, that quarterly payment was coming due. And it has just gotten to the point where they just can't do it anymore. So IFTA is not a heavy tax, and it all depends on how many miles every trucker travels in each state and how much fuel they purchase in each state. So I've seen truckers that constantly get refunds each quarter, depending on where they travel. And I see some that end up owing quite a bit, but it really depends on that trucker and the miles that they travel. So I've, being in the insurance industry and as well as the compliance side of it, the ones that are ending up shutting down, they've been hurting for a while, and they just can't keep it going. So it's probably been in their radar for at least 6 to 12 months prior to finally shutting down or leasing on to someone. A lot of them just want to take that overhead off of their and put it on, and they lease on. That's what I'm seeing a lot of. As many owner operators that I'm seeing start up, I'm seeing just as many shut down. So
yeah, our numbers show about for every 10 that leave, 8 join. So we're seeing a similar trend on our side of the business. On terms of payments, do most carriers pay for their annual insurance? Do they pay it in one lump sum, or do they pay it quarterly or monthly? What's the common?
I would say monthly is probably the most common, especially with startups. We have a lot of insurance carriers that offer pretty flexible payment plans where they will do 12 monthly payments. They'll do like 20% down in 8 or 9 installments. As they go in business, we tend to see them change their payment plans after a few years. Maybe they'll go quarterly. Some of them will have enough that's saved, or they'll just pay it off depending on the rate. But that usually comes with, some experience, some tenure under their operation.
Right. On the insurance side, what are you seeing in terms of insurance costs? Because we hear a lot about rising medical costs and claims getting longer in terms of adverse development. What are you seeing on the commercial auto side?
It really depends on the trucker, honestly. With starting up, 15 years ago, I could ballpark out numbers like all day long, but it's not that way anymore. There's so many factors involved in it now with insurance scoring. A perfectly clean trucker with, that's been driving for a long period of time and staying pretty local. And I can only say this based on my area. We have a lot of agricultural haulers in our area. They can be anywhere from $7,000 to $9,000 a year. But then you throw in a couple of violations on the driving record, or an accident, or not a really good credit score, and that just increases from there on forward.
Yeah.
Guys that have been in business for a long time, those insurance rates are based upon their drivers and their loss history and their SMS score from DOT. And it can be pretty hefty if all of those are not acceptable.
If a good score is 7 to 8 or 7 to 9,000 per year, what is the range on if you have a bad score? I'm sure it can go all the way to you can't get insured, but are we talking 15, 20,000?
I mean, I've seen it be as high as an owner operator be $40,000 a year.
Wow.
Yeah.
Wow. It's hard to stay in business.
Yeah, and we just shut down that conversation real quick. But it could be crazy. It's almost scary sometimes when I see the numbers come out. I'm like, really? So why it's definitely things have definitely changed over the past 3 or 4 years, especially with new authorities and stuff like that. So
And some states don't write new authorities. Is that correct? Or some insurers in some states?
Some insurance companies don't write new authority. We're pretty fortunate with our agency. We do have most of the companies that will write new authorities in a lot of our surrounding states where all of our agents are. So we are very fortunate with having all of the markets that will apply to that. And then it's just up to us to make sure that we fit in with the best one, depending on our conversations on what they're hauling now and versus what they want to do 5 years from now, because it's always changing. There's never any consistent, there's always a change.
Erica, I know you've been around the industry for a long time and you've seen a lot, and this soft market cycle that we're in is the longest that we've seen in our data. What is the sentiment that you're hearing from the drivers as you talk to them? Is it hard out there for them?
It is. It's
How are they
hard.
talking about the potential turnaround of rates in the future?
They don't, honestly, it's very hard out there right now. We've got the rates that are out there are just ridiculous. That, for some of these, what these guys want that specialize in what their hauling is concerned, that they just can't foresee taking these loads because it's just not making them money. I've been through the 2007, 2008 time, where it was awful. Trucking took a huge hit. And, I sometimes I see a correlation between then and now. Like some things are happening now, which I, have flashbacks back to then. And it's a little scary, to be honest with you. But I feel like, some of the carriers that are being weeded out now, they probably need to be weeded out, to give an advantage to those that know what they're doing and have been in it a very long time. So I'm hoping that, I don't know, it's an election year. There's a lot that we have to be concerned about. So we just have to, I guess, just ride this wave out for the rest of the year to see what 2025 is going to hold for us. But it's going to be a lot more of this, I can tell you that.
Yeah, that fits with some of our economic forecasts well into next year. But I pulled some data last month from the start of the pandemic, Erica. There were 451,000 carriers have joined since the start of the pandemic. Only 380,000 have exited. So it leaves about 13% of those that joined at the start of the pandemic still active in the industry. And I think that's part of the reason the carriers are hurting so much is there's too much capacity, both the spot and contract market. Rates are about where they were in 2019, but our operating costs are about 21 cents a mile higher than 21.19, which is why everyone's sort of feeling squeezed right now. There's no relief this side of early next year at this stage, pending, I guess, hopefully some good news this week with the Federal Reserve hopefully dropping interest rates. But not a lot of good news for carriers on the horizon at the moment.
No.
Question about insurance. What's if someone's got some claims experience and they've got a reasonably high insurance premium, what sort of advice would you give them other than, don't getting violations and not having accidents, the obvious ones? What other things would you suggest they do?
Well, once they get to the point where they've gotten such high losses and high SMS scores, there's really not much advice that I can give them. It's really they have to wait for things to fall off of their history before things turn around, and then they need to start implementing procedures and rules and crack down on their drivers and to prevent new things from coming on. Because their insurance rate's not going to go down instantly. It's going to take time. Time is their best friend at that moment, really, and they just have to allow time to pass by so that things can fall off and they can kind of get a hold on it. If they're an owner operator, sometimes I'm like, you need to get out of the truck and you need to manage your business, right? Because it's awful right now, and they need to clean things up and they need to get a handle on their situation so that they can improve. But I try to, one of the things that I do with my customers is I monitor their DRT number. So every time I try and jump in front of that freight train before it crashes into them, I'm out, there's things that you need to be doing along the way to prevent yourself from being in that position. So there's some that don't listen, that they've got to do what they've got to do. And I get that, but
Yeah.
They're going to face the consequences, unfortunately. And
Yeah,
they're not good.
when I worked at Lancer Insurance, which is a long haul truck book you're probably familiar with, one of the things we always got was sort of late afternoon panic from a carrier looking for a certificate of insurance to try and get a load.
Mhm.
They're obviously sitting on a loading dock, and insurance was a big question. What sort of advice would you give carriers in that situation that are stuck on a dock and don't have the right paperwork?
Well, it depends on how late in the afternoon on Friday, but we usually knock our stuffs out for our guys because it's we understand that a certificate of insurance is absolutely paramount to to keeping them in business. I mean, I don't know how many certificates of insurance we issue today, but I'm pretty sure it's in the thousands. So it's
Right.
crazy. And we actually have the capability of setting them up to issue their own certificates. So as long as the carrier doesn't need to have any special verbiage or coverage added, they can issue them all day long. So
Right.
it's takes that stress off of them. But I mean, I'm in this business because of these truckers. So if it's 5 o'clock, if it's 6 o'clock, it's 8 o'clock. If there's something I can do, I'm going to get it done so they can get loaded. That's important to have that kind of relationship.
Yeah.
We're in a unique situation with our truckers.
I was at a conference last week, and we were talking about motor truck cargo limits and exclusions and things like that. One of the things that I heard that was really strange was this exclusion about a bridge. Like, so if the truck hits a bridge, there was an exclusion on a policy. Is that a common underwriting exclusion on insurance policies, or is that fairly rare?
It used to be quite common. It's not so much nowadays. A lot of the known trucking insurance companies out on the market now don't have the exclusions that they did 5 or 6 years ago. That's for if the cargo hit the bridge and not the truck. So it would be excluded. There are some insurance companies that still have exclusions on the policies for things like wetness of load. If you're hauling a load of lumber and it gets wet, it's not tarped and it gets wet, there's no coverage. There's quite a few exclusions out there that a lot of guys don't realize. And that's why I tell them it's very important that you have a very good communication with your agent so they know what you're hauling and to make sure that we've got them with the right insurance company. Because I mean, if they go from, hauling grain to hauling livestock, we have two different worlds here, and we got to get them with a different company that's going to be able to cover that livestock better, because the company that we had hauling grain's not covering that livestock like they should. So we have other options for them, but it's very important that they have conversations and letting them know what they're going to be hauling now, what they might be hauling in the winter, because there's so many, what ifs, with these insurance companies that we got to make sure that we've got them protected correctly. I mean, we remarket our business quite a lot just because of our industry and how active they are with changing their hauling. So it's important that we know our companies, which we do, and make sure that we get them with the right one, because we don't like to have that phone call with anybody that something's not covered.
Erica, you said a lot of your customers are in the agricultural industry. Are you guys facing much with cargo theft?
No, not on the agricultural side. I really haven't had any cargo theft claims. I mean, I've been in the insurance for 32 years this year, and we saw more of it with the dry van and reefer about 20 years ago, but we haven't been seeing a lot of it. We do every once in a while have equipment theft, but it's very rare. We're very fortunate, I think, to be in an area where it's not prevalent. Down in your area in Florida, it's huge. I mean, we tell our guys, if you're going down there, do not leave that truck.
Right.
So.
Right.
Yep.
Erica, I think for July 1 renewals, the state of New Jersey increased the bodily injury physical damage to about 1.5 million.
Yeah.
A couple of questions for you. Do you know if that impacts just New Jersey domiciled carriers or carriers traveling through the state?
It's only New Jersey domiciled carriers, not traveling through the state. So we are having to see, I have quite a few truckers in New Jersey, and we're starting to increase their limits now. For obvious reasons, they are seeing an increase in premium, but it's not substantial. It's warranted based on the limit, it's reasonable, so that it's not, they're not having any sort of sticker shock by that increase. But yeah, it's all of our New Jersey domiciled motor carriers are having to increase to 1.5.
Yeah. Lastly, just talk a bit about cargo coverage limits. There are standards that people have, but we have a lot of, for example, high value loads like cherries.
Sure.
Or lobsters in our business. Can you talk a little bit about some of the things carriers need to watch for and what they can do to protect themselves in the event they don't have enough cover?
So, I think the industry standard is still about 100,000 in cargo coverage. But yeah, depending on what you're hauling, the limit needs to be adjusted accordingly, and it's all based on if you haul sort of specialized type freight. I mean, there's the industry average of 100,000, but when you start hauling things like seafood or equipment, machinery, I think we're fortunate too that if we do have a carrier that comes into a situation where they need to haul a load that's worth a substantial amount more than the 100,000 that we have, then we're able to place them, a quick, it's called a load shore policy, which is just a cargo trip policy to get them what they need. But not all agents have that, and not all insurance companies will accommodate that higher limit. So they definitely need to check beforehand before they book that load that they're going to be able to have the correct amount of insurance to haul it. And it's affordable because, they're not taking into consideration the insurance company is going to charge a pretty penny for that trip endorsement. And are they making enough on that load when it's all said and done? So it's important that they make sure that they are with a company that can accommodate those higher requests when needed. And there are some insurance companies that will issue what's called a shipper's endorsement. So if they're commonly hauling that increased limit for one particular shipper, we can put a designated shipper's endorsement on their cargo policy that says, okay, that they'll have $500,000 only when they're hauling for this shipper. It helps keep the rate down a little bit, so they're not paying for that $500,000 all the time, only when they're hauling for that one particular shipper. But there's options. They just need to be able to talk to their agent, make sure that their agent has options. That's huge for them.
Fascinating. All right. Well, we're a bit over time. This has been a fascinating discussion, Erica. Before we wrap up here, a couple of shout outs. Chris Kapelis is talking to Philippe Capella, CEO of LoadSmart, about how they're using AI in transportation. That's due out this Thursday, if I'm got my dates right. Don't forget DATCon's coming up, Kansas City, October 22 to 24. Erica, before we go, how can people contact you if they've got some questions about income tax, fuel tax, or insurance?
Sure. They can email us at wilsonTransportationServices@gmail.com. They can call our office, 410-819-3153. I'm on Facebook. They can message me on Facebook. I'm always around.
Fantastic. Thank you. Well, it's great to have you on. Glad we connected. No doubt we'll see you and that big goods insurance Kenworth at a truck show soon.
Yeah,
looking forward to that with Chris. All right. Don't forget, it's National Truck Driver Awareness Week. Make sure you give a shout out to any of the truck drivers you see. Remember, a wave goes a long way. If you're out on the highways, make sure you set up alerts for our live show and subscribe to our channel, DAT Freight and Analytics. And with that, another show is in the books. Be safe, be nice to everyone. We'll see you back here next week at 10 a.m. Pacific, 10 a.m. Eastern, 7 a.m. Pacific.